Stuart, I want to start with you and have you parse readers' comments for a second. The economy, he said, it's in good shape. Do you agree?
Well, he says the economy is in reasonably good shape. It's not firing on all cylinders, but I do think that he overstates the case for weakness at the lower end of the income distribution.
You don't think it's as bad as he said it is?
I don't think it's as bad as he says it is, mostly because he's focusing on labor demand. And I'll concede the point that the pace of hiring is slow, perhaps even too slow to maintain a steady unemployment rate at 4.3%. But at the same time, we've seen really slow growth in labor supply. If anything, there's just a tenuous balance in the labor market right now. And that balance does mean that there's not going to be a more rapid deterioration in the labor market. It also means that GDP growth, consumption growth, and income growth will not be supercharged. So instead, we're going to see something in the fourth quarter like just over 1% annualized GDP growth. That's about half the pace of potential, but it's far from, screaming cyclical downturn. It's far from screaming recession risk. And so, again, just an economy that's not firing on all cylinders, but it's not one where the bottom is falling out either.
All right, Ed, so come on in on this, because it's been an interesting week where we've seen an equity trade where it feels like risk off. I think the expectations about the Fed, what comes December, maybe it's not a given. We certainly got that guidance, if you will, from Fed Chair Jay Powell at the October meeting. So walk us through your take on what we've seen in the markets this week.
Yeah, Carol, I think what we're seeing is a little bit of uncertainty about what's happening, both on the Washington, D.C. front where I am, and also in terms of, what the Fed response is going to be. It's interesting because today we were to get the second jobs report that we haven't seen. That's the first time that's ever happened, that we've missed two jobs reports. So we're flying blind in terms of the actual official data. And I think that the market is trying to come to grips with that. What's actually happening in the economy, we don't really know. And before, when we had gotten 1 month of shutdown, we were thinking, okay, that's doable. But now that we're into the second month, we're seeing the SNAP benefits, we're seeing the travel delays. It's hitting more than just the DC area. And so the market is starting to wonder. And at the same time, you have the Fed coming out. You have Beth Hammond, who is the Fed president for Cleveland, saying, really she's more concerned about inflation at this point. She's a voter in 26. Same thing with Lori Logan, who's a voter in 26. I think that, the market is starting to wonder, has it gotten ahead of itself in terms of its optimism as a result of AI?
Yes.
Well, hey, we don't know. We don't know.
Well, some say yes.
Thank you,
Go
Carol.
ahead, Stuart.
Well, look, I think that there is far too much optimism about the productivity growth that can be generated from AI, but we are clearly seeing some of the ramifications of AI in the labor market. Demand for labor is slowing. We are seeing layoffs in the information industry. You look at efficiency gains in the information industry. Relative to late 2019, real GDP generated by the information industry is up 25%. Headcount in the information industry up just 1%. So we are seeing the ramifications of AI in the industries most exposed to it. But when it comes to productivity gains economy-wide, I think that, yes, the case is probably overstated. To go back to Ed's point that there's a lot going on in the economy that's really difficult to measure right now, and the Fed could be flying blind. Well, I think that one thing is certain is that when we look at the broad swath of economic indicators and the broad swath of alternative labor market indicators, labor demand has slowed. And given the fact that we do have more hawkish FOMC members becoming voters in 2026, I would not be surprised to see a precautionary cut in December as the Fed, again, looks at these alternative data that show labor demand softening and in preparation for a more hawkish committee next year.
Ed, as you mentioned, we're sort of flying without information too. We get some anecdotal information. We find out what's happening at Sweetgreen, for example. Shares today down 9.6%. What's happening at Kava and these other lunch spots that were typically trafficked by young people who felt comfortable parting with $15 for lunch. Not so comfortable doing that now. We heard as much from Chipotle and McDonald's as well. Anecdotally, how is the consumer doing?
I think that definitely the top tier is doing well. But then, between what Rick Reeder said and what Stuart's saying, there's some level of distress beyond that. How much, we don't really know, but we do know that the top 20% is really the majority of consumption in the economy. So if you take an aggregate, basically the economy is still pushing forward. One thing I would add is that we have 6% deficits, 6% of GDP for 2024. If you think about 2025 or fiscal year 2025, we're going to get about that same level. But then on top of that, we're getting these tax cuts, which were supposed to be offset by tariffs. To the degree that we don't have the offset from the tariffs, that's even more stimulus into the economy. And I think it's the uncertainty of that nature that is creating a churn in markets. Which direction are we going to go is what markets are telling us.
Well, Stuart, come on in on that, because why wouldn't the Fed wait? I'm just looking, the first Fed meeting in 2026 is January 28th. Why not wait? Because there are stimulative things coming into the economy, the tax cuts and so on.
Because we're still in the middle of a government shutdown. The cost of a government shutdown is accruing. You know that you're going to see really poor Q4 GDP data, and you know that had the jobs report been released for September and then for October, you would see an unemployment rate probably breaching 4.5%. So when we get to December, it's going to be really hard to rationalize not cutting, I think. And given the fact that, again, we're going to see hawks coming down the line, it's a little bit of a precautionary cut because you could expect the Fed to remain on hold in Q1. That's what I expect from the Fed in December, and I think that's a reasonable rationalization if you are a monetary policy maker that doesn't have the full set of cards in front of you.
Ed, I want to give you the last word because you write the Everything Risk newsletter. The group text kind of blew up this week with this market sell-off. One of my friends saying, I think this is it. Look, I'm not going to ask you to call the top here, but you've seen other cycles before. Things, by many measures, are expensive. Just 30 seconds on the market reaction from you.
Yeah, I think that the market can get even more expensive. Just because it's expensive now doesn't mean it can't get more. If we get through this shutdown, there's so much stimulus that's going into the economy that we can have another leg. And remember, we don't have a pure play IPO that's come out of the likes of OpenAI. When you think about the internet bubble, it was those kinds of IPOs that kept the market going. So we can go higher.